Hi all, this is Akshara Menon from PMS Bazaar, welcoming you all to an exclusive NRI webinar series. To inaugurate this, we have Mr. Bhavik Thakkar, CEO, Abans Investment Managers. Bhavik has around 18 years of experience in financial services. He is a Gold Medalist MBA from North Gujarat University. Bhavik has worked across retail banking, wealth, and investment management. His experience includes client relations, investment advisory, and product management. He had worked across organizations like Kotak Mahindra Bank, Aditya Birla Wealth, and Standard Chartered Bank before joining Abans Group. Bhavik joined Abans Group in 2019 and has been instrumental in setting up investment management vertical. Today's topic will be on ease of investing in global alternatives, the Abans way. From this webinar, we can gain knowledge on navigating volatile markets and seizing opportunities for growth. Today, we'll explore the power of market-neutral arbitrage strategies in turbulent times, examining how they can provide stability in returns when equity and debt markets are imbalanced. Also, discover how to earn market returns while maintaining liquidity, ensuring your investments remain agile and responsive. To uncover more, let me give the podium to Mr. Bhavik. Over to you, sir. So, meanwhile, I request all the participants to drop in their questions in the Q&A box.
Thank you, Akshara, and thank you, the PMS Bazaar team. Hello, everyone. Good evening, good afternoon. It's my absolute pleasure to be here today. What I'm going to do is that I'll share my screen, and intend to cover today is there are two products that I want to cover today. Two, as Akshara rightly mentioned, investing in global market. There are two propositions that I want to talk about today. So we'll take it one by one. And before that, I'll give you an introduction to the Abans Group as well, right? First, let us understand about Abans Group. We are, of course, headquartered in Mumbai, but we are a global organization. The group is promoted by Mr. Abhishek Bansal. If you look at our brand name, Abans, it is a combination of our promoter's name. So A comes from Abhishek, that is his first name, and BANS comes from Bansal, that is his last name. So both name put together comes the brand Abans. And the group started in 2005 with the promoters focus on the proprietary fund management activity. So those days, particularly in the Indian market, the commodities were at a very nascent stage. The entire derivatives market was at a very nascent stage. And more so, the commodities were, at a very, very nascent stage. The multi-commodity exchange had just started, and there were a lot of arbitrage opportunities, not just within India, but also in the global market. So that became at the starting point in terms of the Abans Group started to focus more on proprietary fund management, that is the main activity. And as the time progressed, what the group did was that apart from developing the strategies to manage money, we also started, getting a lot of market access, right? In terms of having a lot of broking licenses on our own, right? So, for example, in 2005, the group started modestly as a commodities trading house under Avans Commodities. But in 2010, we set up a broking company in London. So Abans Global Limited was set up as a broking company in London, which is an FCA regulated broker. And through this entity, we have a direct membership with some of the global exchanges like the London Metal Exchange and DGCX and some of the Chinese exchanges and so on and so forth. In 2013, we registered an entity in Mauritius, which got registered under the collective investment scheme, that is the CIS regulation in Mauritius. And this then became the fund management vehicle for us through Mauritius. In 2017, we started with the NBFC business in India. So Avans Finance came into picture so far as the group is concerned, right? And as Raksha mentioned in her introduction, that the initial focus of the group from 2005 till about 17-18 was to manage proprietary money. That was the main activity, and that continues to be the large part of our revenues and the profits today. But what we started, I joined the group in January 2019 to set up Abans Investment Managers. Because if you think about it, the group had already, created a lot of ecosystem and, nurturing those ecosystems and creating, the product verticals, we can become an asset management company over a period of time. So that was my objective of the joining group in 2019. Otherwise, I've always been a banker, as Akshara mentioned in her introduction, right? Just to give you a sense of how do we look like from an organization structure point of view, we are of course a listed business in India. So Abans Holdings Limited is our parent company, which is listed on Bombay Stock Exchange as well as National Stock Exchange. And this is the entity under which the entire financial services business is housed. Like Abans Finance is our NBFC, more than 300 crore of net worth we have here. Then we have Abans Global Limited, which is the broking company in London. Abans International Limited is the asset management vertical in Mauritius. Then we have the India broking companies as Abans Securities and Abans Broking Services. And whatever we do for the third party investment management, the non-proprietary fund management that we do is under Abans Investment Managers Private Limited, right? To give you some highlight on the financial performance of us as a group, these are audited numbers because we being a listed company, we are obligated to come out with quarterly results. So these are audited results as of the last financial year, that is FY23. Even for the 3 quarters that the results that have been declared, our profitability was higher than compared to the last year, full year put together, right? And the net worth of the group will be in excess of about 1,000 crores, which is close to about, say, $120 million or so, right? So, and the debt equity ratio is very comfortable, under 20% so far as the group is concerned, right? So the group started 2005. The focus was on proprietary fund management. From 2019 onwards, we started managing money for external investors. So what are the kind of products we offer? I will bucket it into 3 different parts. The 2 products which we are going to cover today, the Global Arbitrage Fund, the Commodities and Currencies Arbitrage Fund that we offer through Mauritius, that is one product category that we offer. The second is that we are a SEBI registered portfolio management service provider in India, which is a long only equity portfolio that we are offering. And we are also offering that product through a dollar version, right? So in my presentation, I'm going to cover that as well. Third thing is that, as NRI clients, you would know that, in the global market, there is a very, very active business on the structured notes or structured products, right? All of you must have invested or at least come across, the products which are linked with, say, the FANG stocks, the US stocks or the US S&P 500 index and so on and so forth. What we do here in India is that we offer Nifty 50 index linked market products. These are, in Indian parlance, it is known as market linked debentures, but otherwise in the global market, it is known as structured products or structured notes. So we are very active, one of the very active players, in this business as well in India. So these are the 3 main buckets of the products that we offer here. So having given you the group introduction, I am now moving to the first product, which is the Abans Global Arbitrage Opportunities Fund, right? So this is the regulatory infrastructure under which we operate. This entity, Abans International Limited, as I mentioned, is registered with the Mauritius authorities under the Collective Investment Scheme and Closed-Ended Fund Regulation. We are registered as an expert fund. If you like Indian parlance, you have the AIF, the Alternative Investment Fund Regulation. Similar regulation in Mauritius is known as the CIS regulation. So we are licensed by the capital market regulator in Mauritius, that is the FSC, the Financial Services Commission, has licensed us as an expert fund within the CIS regulation. When it comes to investment strategy, when I say the name of the fund is Abans Global Arbitrage Opportunities Fund. So I am using 2 different phrases here. I am saying it is global, and I am also using the word arbitrage, right? So what do I mean by that, and how do we imbibe that into our investment strategy? When I say global, we are having global commodities and currencies which trade on global indices or global exchanges rather. The futures and options contract of various commodities and currencies. When I say commodities, all your base metal, precious metal, energy complex, and some of the currencies, global currencies, the futures and the options contract that trade on global market is our universe, right? We, for this particular product, we don't look at any equity security so far as the arbitrage transaction is concerned, right? And the second phrase that I'm using here is an arbitrage strategy, right? So global arbitrage fund means we execute various types of arbitrage, right? And let me define some of those for you. So I'm going to give you two different examples of the underlying transaction, right? What do we do when the money is invested in this fund is what I'm going to explain you now through this example, right? So first, let us understand an arbitrage transaction on copper as a commodity, right? So all of us know that this base metal trades on global exchanges. So here this example actually compares the price of copper across London Metal Exchange, that is LME, which quotes the price in terms of per ton, that is 1000 kg. And then on the other hand, you have the CME, Chicago Mercantile Exchange, or COMEX as it is popularly known as, right? And there, if you look at, if you just Google around it, the price is quoted in the form of LBS or pound. So when you want to do an arbitrage or when you want to compare the two comparables, you will have to bring them into common denominator. So when you convert the CME price into LME equivalent, which is from pound to say tons. So first multiplied by 2.204623, that will convert it into kg and kilogram, and then into 1000, where you'll convert it into tons. Then you will see that there is a price difference between the two, right? Now, obviously, there will be price difference because of the local factor as well, right? But if you look at in the commodity space, it follows a mean reversion, right? So if, for example, if LME copper minus CME copper, if the usual price difference is, let's say, $30, any deviation to the mean will give us an arbitrage opportunity, right? So here we are not basically, we are not trying to predict the price of the commodity per se. We are not saying here that whether the commodity price will go up or will it go down, and accordingly I take the position, because then that becomes a directional call, right? Which is what we don't do in this particular product. But here the focus is more on the spread play, right? So as you can see here, as let's say if I go long in LME market, I'm short in the CME market for equal quantity, which is this 75 into 2.2023, that is the conversion rate. Okay, if you keep doing it, so you'll understand that it is the equal quantity that I'm long and short. Now, what this ensures is that A, I am not taking a directional call. B, it's a call on the spread per se, right? Now, you would have understood that, or you would know that in the global market, the commodity prices or even the currency prices will move in tandem, right? So what I mean to say is, suppose for any reason, the LME copper prices are up by 2% today. On the other hand, let's say CME price also will be up by say 1.9% or 1.8% or 2.05 and so on and so forth, right? What I mean to say is that it is very difficult to conceive that the LME price is up by 2%, but the CME prices are down by 2%, right? I mean, that doesn't happen because of the very existence of arbitrages, right? So as the spread changes, we change the pattern of the transaction, wherever we have, I mean, we book the profits and so on and so forth. And that is how these transactions are carried out, right? I will give you another example on the currency side, right? So this was an example on copper as a commodity. Similar kind of trades can be done on many other global commodities like the base metal and precious metal. I'll give you another example on, let's say, currency side. So let's say Indian rupee versus dollars, the trade, the future contract on on this trade happen on this particular currency futures contract trades on DGCX, that is Dubai Gold and Commodity Exchange, and it also trades on Singapore Exchange, the SGX, right? Now, for example, right now, say for the April month expiry, the DGCX is quoting at a price of say 83 rupee 25 paisa, and let's say the SGX is quoting at a price of say 83 rupee 26 or 27 paisa. Let's say even if there is a 1%, one basis points, or sometimes even fraction of that, that is the difference. How we can profit from this is that one can go long in the market where it is cheaper, go short in the market where it is costlier, right? And at the end of the month, because this is a cash settled contract and it will get settled at an RBI reference rate on the last working day, because of these configurations, any price difference between the two can actually be availed as an arbitrage profit, right? So these are the kind of transactions that we execute, so far as this product is concerned. And if you look at in terms of the returns that we have been able to deliver, this has about 7.5 years of track record now, the Abans Global Arbitrage Opportunities Fund. And we've been averaging at about 8% returns in dollar terms. If you look at even as the topic today is that a market neutral strategy, right? You look at the calendar year 2020, where the entire world was struggling with the COVID and the related challenges, right? And the world over, the equity markets were going down, and the interest rate markets were also very volatile, and of course the commodity market as well. You would see that our returns were almost 9.5%, right? Because the volatility was the highest during that time. In fact, if you just do more granular, the April, May, June 2020, if you look at the 3 months return, put together, this particular calendar quarter was the best result, best performance that we have been able to deliver, compared to any other calendar quarter, right? Why? Because the volatility was highest during this COVID period, right? April, May, June 2020, when the world was getting into lockdown. And that is, volatility is a friend of arbitrage. More the volatility, better it is from our point of view to generate returns, right? And let me also tell you that what is one of the most important aspect why we are able to deliver about 8% returns in dollar terms, right? So here, the magic is in terms of the margining system, how the global margining system works, right? Let me give you an example. Say, for example, I am long on LME copper and I am short on CME copper. Now, say this transaction, both the transactions are executed through my broker as a JP Morgan. For example, JP Morgan is my broker for executing this transaction. Now, in the global market, and I'm sure all of you being in global market would agree with me that the margining system, when you execute transaction in futures contract, you are supposed to pay margin, right? You're not supposed to pay full amount of the nominal position. You're supposed to pay only the margin, right? So for example, when I'm long on LME, when I'm short on CME, through one broker, say JP Morgan is my broker, and let us say the broker requires a margin of 2 to 3%, for example. So for every $100 of position, I will have to deposit $3 as margin, right? Now, as you would have noticed that suppose I take this position today, and at the end of the day, copper prices are up by 2%, in let's say in London market. Obviously, in the Chicago market also, and the CME also, the price would go up, right? I mean, it is very difficult to conceive that the price in one exchange goes up and the other exchange comes down. The arbitrages would not let this happen, right? I mean, they will keep trading to ensure that the prices are in check, right? So what happens is that when I am long on LME and the price is going up by 2%, I am making that profit in London Metal Exchange, mark to market profit, whereas my CME position will lose almost that much, right? So because of this equation, my mark to market margin, if you understand the how the margining system works, for the profitable position, I will get money from the exchange. For the loss making position, I will have to pay money to the exchange. Now, if this was two different jurisdiction, then this would have been an administrative nightmare. But because it is through one broker, JP Morgan is my broker, for example, my mark to market profit gets adjusted with the mark to market losses. And therefore, I don't have to worry about moving money from one to the other, right? And what this enables, that is the single most important aspect for us to deliver 8%, is that it helps me leverage many more times the capital that you give me, right? So if you invest $100 and if $3 is my margin required, I can effectively do 30 to 33 times the position, right? Because of this mark to market management is not required to be done. I can actually leverage, and therefore when my profits, if you think about it, the example that I give you on INR USD also, it is minuscule profit, right? Percentage per transaction is minuscule. But when I'm able to zoom it up by another 30, 33 times is when I'm able to deliver about 8% returns in dollar terms, right? So what you're seeing on your screen right now is month over month how the fund has performed for about 7.5 years. And these returns that you see are net returns. So the fund charges management fees of 2%. and beyond a 0.5% hurdle rate, there is a performance fee of 20%, right? So the management fee and performance fee is all, what you saw in the previous slide. This performance is after charging of the management and performance fee. These are net folio level returns that the investors get, right? And as per the Mauritius regulation, the minimum investment size is $100,000, and this follows a monthly NAV cycle and so on and so forth. There is no lock-in period, there is no exit load. So in a way, if you think about it from a global allocation point of view, this becomes like a liquid alternative, right? If you have a 3 months, 6 months, 1 year kind of a need, you can look at this. And there are a lot of investors, especially NRI investors, offshore investors. 95% of our current AUM is consist of the NRI stroke offshore investors, because you already have the dollarized assets. It becomes easy to invest in dollar terms, right? The fund is open for all investors except the US investors. Canada, etc., all other jurisdictions are open. GCC and Africa and all, we have a lot of investors from. So except the US, as a US person, anybody can invest, or even businesses can invest. If they have surplus, they can also invest into this particular fund, right? So I have covered on the global arbitrage fund. Now I will move to the second product that I wanted to cover today. And then obviously we can have a Q&A. We can go back to the global arbitrage presentation if that is required. So the second product that I want to talk about today is our portfolio management service in India. We are a SEBI registered portfolio management service provider. And as you would know, portfolio management service is your long only equity portfolio, where the fund manager invest into the equity strategies, right? So of course we've been this particular product has been there for 12 years now, and Kaushik Dani is the fund manager. Okay, we have the investment committee, consisting of Kaushik, and I'm also part of the investment committee. We have other professionals, who have spent good amount of time in the market. Mr. Shekhri and Mr. Anmol Shekhri has more than about 40 years of experience of being into equity market. So we also get guidance of some of the legends who have spent a good amount of time in the market, to guide as an investment committee member. What this is a multi-cap strategy, and it started in 2012, the growth and momentum portfolio, and so far it has delivered about almost 12 times the return since inception. A 50 lakh invested has become almost upwards of 5.75 crore plus. In rupee terms, it has resulted into a CAGR of almost 23%. This is the performance that we've been able to deliver, right? I mean, if you look at the long period, and also compare it with the exchange, compared to the BSE 500 index, there has been a consistent returns, that we've been able to generate, right? I will obviously in the presentation, there are few slides on the Indian economy and all, but I'm not going to cover that because all of us, follow the Indian economy very well. And, the entire world is looking at Indian exposure, right? I mean, whether any approach that you look at, right? So what I would rather highlight here is some of the decision-making criteria, when we look at some of the stocks or some of the sectors to invest in, what are the things that we look at, and what are the things actually we avoid. In fact, we focus more on the avoid list rather than look at the selection list, right? So out of the BSE 500 index, we look at some of this qualitative and quantitative filters in terms of the quality of earnings, the quality of growth, whether there is a capital efficiency into the business. And then obviously, the typical, parameters like the valuation of, the various aspects of looking at the valuations part of it, right? That becomes the selection criteria of, being in the portfolio. I think this is a very important slide. I think, over a period of time, investing decisions sometimes become easy, but actually exiting from a particular stock becomes very, very difficult, right? I mean, so these are some of the well-established triggers, that would definitely warrant for us to, exit a particular stock, because there is absolutely no scope for any kind of a corporate governance or anything, any related issue. For example, for example, we had, this polycab in the portfolio, right? And then there was this news article that, there was this, they have evaded about, say, 1,000 crore worth of sales. There is a corporate governance related issue, or it is the allegation has been raised, right? So even if it is a very, very promising company, unless the dust settles, even if we have to exit at a loss, we would not mind that, because corporate governance, becomes the most important aspect so far as the businesses are concerned, right? So this is the current mix as of March end, and we have a very strong conviction about being into the small and mid cap, right? Because a lot of people would have, said that, okay, now that, the SEBI has asked for a lot of data about the small and mid cap exposure, this sector is not going to, this part of market cap is not going to perform, and so on and so forth. But the as we are in the mid of April, a lot of things have bounced. In fact, from the lows of the March, where we had the small and mid cap, going down the drain, a lot of things have bounced, and the portfolios are looking with much stronger compared to where we were at the end of March. I would just quickly like to highlight some of the exits. I think, what is important from your point of view to evaluate us is that how do we think, because our thinking will actually go into the portfolio construction. So our kind of thinking becomes most important criteria for you to evaluate that, are we doing good job or not, right? I mean, are we thinking in right direction or not, right? So for example, when ABB Power was sold over to Hitachi Energy, I mean, when ABB wanted to exit this business, this category of business, it was bought over by Hitachi, as in this company, Hitachi Power, Hitachi Energy, right? Now, this business has actually gained a lot of momentum because of the entire rail electrification and the entire digitization, and so many things that unfolded over a period of time. And we have this particular stock in the portfolio from August of 2019 onwards, and we've delivered almost about 7x, 7 times the money, about 625% is the return that this has delivered into the portfolio, right? So our objective in this strategy would be to identify such stocks, and stay on to with it for a long period of time. That is our way of thinking. Similarly, whether it is the chemicals company or this power mech project, where we able to identify in September 22, and then obviously got almost 2.5x reward of the investment, right? Again, the chemical space also, we could identify stock and stayed with it for a long time to generate returns, right? This is the list of some of the other stocks that we have bought and sold, exited. So what I showed you previously is some of the stocks that we continue to hold, and these are the stocks that we have exited and made profit, and so on and so forth, right? So it's a very active space. We look at of course, the BSE 500 is the index, is the universe that we track, but we look at only, say, having 25 stocks into the portfolio, right? So let me now talk to you about ease of investing, right? Because those who are tracking in the Indian equity market, you might have invested through mutual funds, through other portfolio management service and AIFs, and so on so forth, right? So obviously, when you want to invest into this particular strategy through, let's say, your portfolio management service account, right, being an NRI or an offshore entity, I'm sure you are aware that when you want to invest in Indian equities, there is this requirement of having a portfolio investment service called PIS account, right? And why is that required? Because the sectors and the stock in India have some maximum limit. Some of the sectors will have, let's say, a limit of not more than 49% of the overall holding in the company can be given to foreign owners, right? Now, as an NRI, when you invest in Indian equity market, it is a foreign money which is getting invested into Indian stocks, right? And therefore, that money also is categorized as a foreign money, and therefore that also is subject to the maximum limit up to which the investments can be done in that particular company, right? I mean, all the foreign money put together, whether it is an NRI investing in individual capacity, or there is a foreign investor, foreign company, or let's say a joint venture partner who is investing in Indian business, right? So in order for RBI, Reserve Bank of India, to track all the activity in terms of whether the foreign investment limit is breached or not, they have come out with this provision called, they've come out with this account called PIS. This is Portfolio Investment Service Account, right? Which is like your bank account, your NRE account. The purpose of this account is that whenever you buy any shares, the payment can be made to only brokers, right? There is no other activity permitted, right? And you can have only one PIS account versus, let's say, you can have a number of NRE account that you can freely open, right? So either through the PIS route, a portfolio management service investment can be done. Okay, and in our experience, opening up the PIS account may be also a little challenged in terms of the time it takes, documentation involved, and sometimes it becomes very, very, sort of a tiring exercise, right? So obviously we have that route available, but what we also have is that because we have the Mauritius entity, we have come out with a dollar version of the same portfolio, the growth and momentum portfolio. So what happens is that you, instead of investing the money directly into the portfolio management account in India, you invest that into the fund in Mauritius, and that fund in Mauritius will be investing into India as a PMS client. So rather than you becoming a PMS client directly, the fund in Mauritius, which accepts money in US dollar currency, that fund will invest into India as a PMS client, right? So what are the benefits, of investing, let's say direct versus the through the Mauritius route? Of course, the PIS account opening challenge, some of you who might have gone through this experience, may also tell other people as to whether it is easy to open PIS account or slightly cumbersome, right? Versus the dollar route, it is very easy to get onboarded to the dollar product, right? Because the basic level of KYC is required to be provided, and it's a dollar to dollar assets, right? You are, let's say, if you have your money staying in dollar, although for investing in Indian equities, it will ultimately get converted into rupee. But when you invest in the dollar fund, you are not required to convert the currency in rupee terms and so on and so forth, right? So that is one. The second thing is that when you come through the dollar fund, you don't have to do all your India compliances in terms of it. Suppose if you were to invest through your PIS account, all your short-term and long-term capital gain, if the fund manager sells the shares before 1 year, it will be resulting into short-term capital gain. After 1 year, it is long-term capital gain. You as an investor through PIS account will have to comply with all your income tax filings, right? Whereas if you come through the Mauritius route, you don't have to do any of those, right? You can invest without any kind of, because whatever is required to be done from a tax filing point of view will be done by the fund, and you don't have to do all of this, right? There is no arbitrage, the taxation arbitrage between the fund versus the direct investment, because if you incur any short-term capital gain, you will have to pay 10%, 15%, and long-term you have to pay 10% in both the methods, right? So that way there is no arbitrage. Obviously, the minimum investment size in the PIS account is about 50 lakh rupees, whereas in case of the Mauritius fund is $100,000, right? We are also there on a couple of global platforms like Crystal.ai and some of Dubai-based platforms, through which the funds can be accessed, right? So these are the pros and cons. We are indifferent. We are open. Either ways, investor can come. But I thought I'll highlight some of these points, right? So Akshara, I'll stop here. I think we are doing fine on time. I think we can now open it up for Q&A. Is there anything that I have missed out or you want me to highlight upon, Akshara?
Yeah, while seeing this webinar, I just had a few doubts. Like the very first thing is that if the market is priced correctly, there's no mispricing. So where do you find this opportunity in arbitrage funds, sir?
Yeah, but so therefore, yeah, so what it does is that, we have extremely large universe, right? So, for example, if one particular commodity is perfectly priced, you will have one or the other opportunity, open, and it's with respect to the global arbitrage fund, and that is exactly what we do, right? And in fact, because of that, we don't follow that there is like a, there is like for example, in a diversified fund, you will follow some prudent norms that not investing more than 5%, 10% in a particular commodity or a stock or and so on and so forth. But in my global arbitrage fund, we don't follow that, because all I'm focusing on is the arbitrage opportunity, right? So even if my all gains are coming from one commodity or a currency, we don't have to worry about that, right? So that's how the diversification comes in. But having said that, we have almost every month 5 to 15 different commodities and currencies sort of generating returns, right? I see some other questions here. Sorry, if I may.
Yeah, I'll take the last question first. For our arbitrage fund, there is still 1% contribution fees and management fees. So, how can someone park funds for short period and as these costs will overweight the returns?
Yeah, so the subscription fee is little flexible, that can be moderated, and then the management fee, performance fee is very standard, that is getting charged. And as a reminder, whatever people saw as a return, the 8%, give or take about 25-50 basis points, was after charging the management and performance fee, right? So even if you have, let's say, 1 to 3 months kind of a horizon, let's say if the setup fee is, say for example, made it zero, the subscription fee that I'm talking about, still people are investing for 3 months, 6 months, 1 year, also people are investing into that, into the fund.
So with that, I think the question is answered.
Yeah.
And okay, and there's one more question. This is Ashish, and I would like to understand if any investor from UAE would like to invest into India. Do they need to invest via NRI account or NRO account? Can they invest directly in Indian market? Can they invest in the unlisted space as well? So you want to take the question? Take it up.
Yeah, so see, in both the products that I spoke about, the only restriction that we have is the US investors. And I also saw that there's one question on why US investors cannot invest, because the fund is not registered with SEC. And therefore, the US investors, unfortunately, we are not able to take. But obviously, we are also working on to get the fund registered. At least the Global Arbitrage Fund, our process is on to get it registered with the US SEC under the Regulation D. And once that is done, then in that fund, we will be able to take money from US investors. But other than that, Canada and all the, of course, UAE, and we have so many investors already from. So they can either, into the portfolio management service, either they can come through their NRE, NRO account, complying with all your PIS requirements. Or if they want to come through the dollar route also, that is also open. One can discuss the time it takes for a PIS account to be set up, and so on and so forth. But otherwise, both the options are available. The fees in the PMS is 2.5%. I saw one question on that.
From Vaishali, yes, yes.
And whether you come through Mauritius route, the dollar route, or you come directly into PMS in India, the fees remains the same as 2.5%. Our objective is to simply give you accessibility, and ease of doing business. Ease of investing is what we want to promote. And that's why we have kept the fee structure same. The management fee is 2.5%. If you come directly into PMS in India, or if you come to through the Mauritius route, it's the same. There is no difference. The only difference is that the exit load in the India version is up to 2 years, 2% and 1%. Mauritius also it is up to 2%, but 3 and 2. The only difference is the percentage change. Percentage of the exit load, but the number of years for exit load is the same. There is no arbitrage between the two.
One more question is that do the investors need any accreditation status to invest in PMS or any Mauritius fund? What is the eligibility criteria to take that?
No.
Yeah.
No, so so far as so far as Mauritius is concerned, there is no such restriction that you have to have an investor of an X caliber, or accredited status, and so on and so forth. Accredited investors, like I'm saying that for some of the jurisdiction like Dubai and all, or Singapore and all, comes into picture only when the fund needs to be registered in those jurisdiction. Is when those things comes into picture. But we don't have any such restriction into that. There was a question on why the fund performance is lower
last 5 years.
last 6
I'll just take the question. Like you had reported losses in a couple of months during the last 5 years of arbitrage fund. So what are the reasons for the same, and what could be done to maximize downside in such trades?
Yeah, so I must congratulate whoever has asked this question, that amongst that so many monthly performance in the year 2018, in the month of March as well as December, there is 0.02% negative return. Let me just go back to that slide. This again, if you think about it, it is a technical underperformance, or rather a negative return, because what you are seeing here on your screen right now is the net return after the management and performance fee, right? So even during the month of March and December 2018, the gross performance would have been positive, but when you apply the, say, management fees, 2% is the management fee, 2 divided by 12 is about 16 basis points, right? So when you apply that, it became a net negative on that. And let me also tell you that, as a fund, we have also learned over a period of time, right? As we've spent a lot of time in the fund, there are things that we should avoid. There are things we should do. So that has been one of the learning. If you actually break down our performance and analyze our volatility during the first 3 years of our performance, 3, 4 years of the initial first 3, 4 years, and the later part of the 3, 4 years, the volatility has subsided substantially in the last 3, 4 years, because we have also learned that there are certain type of transactions that we should avoid, right? In the process, it might be generating little more return compared to what we would have envisaged. But to be honest, in this particular fund, we follow SLR as a principle, that is stability, liquidity, and return, right? Let me tell you on record that returns is not our priority number one so far as this fund is concerned, because most of the investors who come into this fund are looking at like a stable return kind of a product, right? I mean, they're okay with, say, 7.5, 8% in dollar terms, and they want liquidity, right? So this product is liquid. There is no lock-in period, there is no exit load, and it has a monthly liquidity, right? So that is the mandate that we follow here, the SLR principle that we follow here, and therefore we don't focus so much on the returns part, right? Yeah, so we can take the next question.
Next question, the Asha Lakshmi, is that if an investor already has a PIS account, because the whole webinar is on ease of investing. So if they already have a PIS account with one bank in India, so and if they want to close it and open a new one, is it a good idea?
Yeah, that is possible. So if you already have a PIS account, then you need to check with the banker with which you have the PIS account, because then they also will have to have the tie-up with the custodian, because the custodians are also, as per the SEBI guidelines, have to be mandatorily involved, right? And then for example, Axis Bank allows up to 4 different account within one PIS, and some other bank allows only 2, and so on and so forth. But yes, principally, it is allowed. If you have one PIS account linked with one particular PMS account, you can always have another PMS also mapped to it, but it has to be facilitated by the banker.
And the one question that I have is that commodity market is under existence ever since human history, actually. So how do you see the trend growing up? And how do you see it gaining more popularity?
See, from our point of view, we are arbitragers, right? So we are not here to predict the price of commodities and so on and so forth, right? So the more the opportunity, or more the volatility, better it is from our point of view, right? So therefore, as a house, we don't get into the forecasting of whether this X thing will go up or will it go down, because see that those things are to be required to be done by for somebody who's taking a directional call, right? We want to focus on a near risk-free profit, right? I mean, we want to grow slow, but we want to grow for a long period of time. And that is why, as a house, we don't get into forecasting of the price direction of the commodities or even currencies for that matter.
Arbitrage funds are often marketed as an alternative to any liquid funds. Is the risk comparable, or do you investors that take more risk choosing the arbitrage fund?
So I would say the risk profile is slightly higher than the liquid funds, because liquid funds tend to deploy money into money market instruments, where the government securities and all are involved. this fund has delivered consistent return, but let me tell you that this is not a guaranteed return product, right? A lot of times you reduce the risk and obviously, smoothen the return because of your experience of, dealing into it. But that doesn't mean that there is no risk involved into it, right? I mean, from our point of view, like for example, for global arbitrage fund, we have to have a simultaneous access to two different markets, right? Now, if there was to be a situation where we have a position and the other, let's say there are two different positions, and one exchange says that, I don't honor commitment. I mean, it is very difficult to conceive that an exchange will say and these are global exchanges, right? But that, even if the probability of that happening is 0.001%, but it is still there. It's not still zero, right? It is not that you are investing into any government-backed securities, which is the case with the liquid fund. So I would say from a risk point of view, this is obviously higher than the liquid fund that people invest in. But our mitigant, as a fund manager, our mitigant is to follow SLR principle, because we have to just maintain, how the fund is being managed consistently, right? So in fact, let me tell you that when the US treasuries, in last about 6 to 8, 1 year, okay, when they were at its peak, somewhere around upwards of 5%, the US treasuries, some of the investors even gave this feedback to us that, I can leverage my US treasury investments and can generate better returns where the backing is of the US government, then why should I come to your fund? So I said that, because some other alternative is available at a better risk adjusted return, that doesn't mean that I'm going to change the nature of my product. And I don't want to increase the risk profile of my product just in the quest of getting a better return, right? For that, I can always have a different product. But so far as this strategy is concerned, and why am I spending little time on this, is that arbitrage is an ocean, right? You have so many different type of strategies that is possible, and everything can be tagged as an arbitrage, right? So some I came across one arbitrage fund where somebody says that, I'm buying from Europe and selling in Russia. I mean, this was long back. But and they say that, okay, I have a confirmed order. So that is also an arbitrage for me. I said, good luck to you. My point is, we have to be very clear in terms of what we are doing. And therefore, even if you have a slight variation, you will have variation in returns also, right? So we want to stick to what we are doing in terms of the SLR principle, and not change the risk profile of the fund, just to get little extra basis points in terms of returns.
So when you say that, so the funds are margined to the exchanges and there's no utilization of any other assets in that fund. Is that what?
Yeah, because we deal with the futures contract. We are supposed to pay margin to the exchanges, the various and in this case through the brokers basically. So like I gave example of JP Morgan being our broker for LME, CME, copper. So we will provide margin to the broker, and then obviously the brokers are required to pay to the exchange and so on and so forth.
So there's no involvement of any physical commodities inside that. So
No, we don't do. No
purely
physical.
derivatives. Okay.
Yeah, we do only derivatives, no physical. That's why I clarified that we do only commodities and currencies, no equity involved, no physical commodity involved, no delivery-based transactions involved.
So what do you think is the key criteria investors should consider when they're selecting an arbitrage fund for investment?
I think, I would say that what we follow, if the investors also follow the same, SLR is the principle, right? So I think there's a matching of, as we match the horoscope, right? So there is a matching of thought process that, if the investors also think that stability, liquidity, and returns is their priority as well, then I think, this is a good product to invest in.
Can you just give me an overview of the same investment for an investor who has invested a year back and to an investor who is just invested now? What kind of a difference can we expect in their portfolio?
So far as the global arbitrage fund is concerned, I don't see any change, in terms of the return profile, because essentially the underlying transactions are similar in nature, right? So, and this is a market neutral strategy, by the way, right? So therefore, any point in time you look at, it has generated, sort of stable kind of return, right? Like you can see that during COVID, for example, when the entire calendar 2020, we delivered about 9.5% return, right? Otherwise, our returns are about 8.5%, if you think that way. So even when the volatility was extreme in during COVID time, we could deliver about 1% higher than our normal return, right? But whereas when it comes to the growth and momentum portfolio, the equity portfolio that we offer, right? I mean, and I think there's also one question that somebody has asked on the 6-month performance, right? So let me just
Yeah.
also invite that into here. That equity market will always, go through its own cycles, right? And you know, you see, people will have to appreciate that an index has a combination of 500 stocks, and I am playing in only 25 stocks, right? So it's always a game of identifying those winning ideas, and it will also take you through a lot of patience test, right? Because sometimes we select stocks which may not have performed from a particular time frame point of view, right? Because the markets always behave in cycles, right? I mean, you'll have some or the other trigger in the X category of stock, whether it is market capitalization wise or an industry wise and so on and so forth, it will perform, right? So from a trading point of view, one can understand that is fine. But when it comes to investing, right? If you have followed the right process of identifying stocks and so on and so forth, then one should not just look at a 1 year or 6 months underperformance, right? Because every business will go through those cycles, right? I would rather take a contrarian view that if there is underperformance, means the stocks that you have identified, okay, they are they once they bounce, you will be able to get much better returns, right? Because investors tend to make this mistake that they will try to chase where the returns are, right? You will say that, okay, if this has performed is when I want to get into it. So, and probably that might not be the most appropriate time for somebody to get into it, because it has already run its course and you are just chasing at it when it is at the top, right? So going forward, I think Indian equities, uh, see, I'll give you some data points here on Indian equities particularly. See, January 2012, just before COVID, the Nifty was at 12,000. Okay. And September 2021, that is 21 months later, even if I assume that there was no COVID, okay, the Nifty was at 17,700. So from 12,000 in 21 months, Nifty advanced by almost 40% to 17,700. Okay, in 21 months, it delivered about 40% return, right? Then next 18 months, from October 2021, the Nifty was at 17,700. March 2023, when 18-month ended, the Nifty was at 17,000. That is a negative return of 3%. And whatever current rally that we see in Indian equity market, that started from April of 2023 onwards, right? From 17,000, market has now gone up to about 22,500, right? Which is another 30% growth. So if you just analyze last 4 years, you had first 21 months, which had delivered 40% return. You had the next 18 months, which delivered negative 3% return. And then you had the next 1 year, which had delivered about 30% return, right? So if you think about it, no market is just going to go through like a linear equation, right? You will have the volatility coming your way. The P multiples, whether it is appropriate or not, whether the earnings will remain as it is, right? Whether it will continue to grow the way it is, right? A lot of things are also dependent on the interest rate. While everybody is forecasting that the interest rates will come down, but the timeline is getting pushed. Earlier, people were expecting June, now it is September, right? And if you, on top of that, if you have any geopolitical or any stress on say crude oil prices and so on and so forth, such decision then gets pushed also, right? So that is why you need an appropriate fund manager that throughout the cycles, if one is able to manage, and we have gone through multiple cycles as it is, reflects. Our returns have been 23% since last 12 years, 2012 onwards. And as I told you that we also offer the dollar version of this portfolio management, right? So if you look at the dollar returns, it is 19% CAGR since, because obviously the currency depreciates by 3 to 4% every year. So 19% per annum has been returns in dollar terms since the inception of, this particular strategy, right? And a ease of investing through the Mauritius route. Obviously $100,000 is the minimum to invest, but it is much better compared to the PIS related challenges that people go through.
And one more question from the person is that as an NRI, Do I make less returns by investing in India, PMS versus Mauritius fund due to forex conversion? If yes, it is always better to invest via Mauritius fund.
Yeah, so I think, so far as the returns experience in dollar is concerned, you know, of course, the currency depreciation will eat away something from your India absolute return, right? So I mean, that was the point I was making. If you look at my rupee returns, it is 23% CAGR since 2012, since inception return, right? But when I adjust it for the currency depreciation, it becomes 19% in dollar terms, right? Because rupee would normally depreciate by 3 to 4%. So if 23 is my rupee return, minus 4% of currency depreciation will give me about 19%, right? So whether you invest by converting your dollars into rupee through NRE account or you directly invest into my Mauritius fund, your dollar returns are going to be more or less same. It is not that you will have a different experience so far as the dollar return is concerned, but where you will definitely have a better experience of investing through Mauritius is the process part, right? I mean, just as the cost of repetition, when you come directly into India, you will obviously will have to come through PIS account, right? Which sometimes become very time consuming process. And also whatever portfolio manager sells for your on your behalf in the short term, like will attract 15%, long term, it will attract 10%, right? Now you will have to file all your income tax returns every year, right? So that becomes sometimes a time consuming process. It's not difficult, but it is time consuming, right? And NRI clients, especially when they are in their other country, I mean their home country, they may or may not have necessary infrastructure in India to file income tax returns, right? Versus that, if you come through Mauritius, the short-term and long-term capital gain tax remains the same, right? Whatever I was supposed to buy when you come as an individual investor versus whatever you come through let's say you come through the Mauritius fund route, the portfolio in India is identical. There is no change. Therefore, the implication of short-term, long-term capital gain is also the same. But here in fund route, everything will be done at a fund level and you are getting NAV-based units in Mauritius, right? So all your hassles of filing your income tax returns, etc., is not required to be done at individual investor level. Everything will be done at a fund level. And there are some ancillary benefits also to it. See, you would agree with me that as a individual investor, when you remit your money from dollar to rupee account, the banker will charge you 25, 50, 75 basis points depending upon your strength of relationship with your banker, right? You would have witnessed multiple times that, right? But when it comes to us as a fund in Mauritius transferring money to India, because we are a corporate and our relation with the bank is such that we would have pre-negotiated rate that we will not let you earn 5 7 basis points on the currency conversion, right? So that actually is an advantage to the investors coming through Mauritius, that you don't have so much of leakage when you convert your dollars to rupees, right? So that's an ancillary advantage to the people who. So if you ask me, if you have an option of say sparing $100,000, which is say in rupee terms is about 85 lakh rupees versus say or 83 lakh rupee versus say a 50 lakh ticket size in India, if that's not a constraint, coming through the Mauritius route might be a much better way of investing because of the ease of investing, ease of doing business.
Okay, so I'll take the last question for the day. Is like, can you let us know how a tax works for UK-based NRI?
Into the global arbitrage fund, our understanding is that so the Mauritius per se, the first product that I explained, the global arbitrage fund, there is no capital gain so far as the Mauritius is going to charge. And our understanding is that most of the global jurisdiction, like for example, East Africa, UAE, in fact, to an extent for UK also, the global capital gains are exempted from any taxation in UK as well. But obviously, disclaimer is that I'm not a tax expert. I would recommend this investor or whoever he is that he should check with his tax expert. But our understanding is that the global capital gains are exempted in most of the jurisdiction, including UK. So that can so that the entire capital gain that you generate from the global arbitrage fund will be taxed free so far as the investor is concerned. So far as the India equity is concerned, whether you come through PIS account, I mean you're opening your own account and come, or you come through dollar route, in both the cases whatever taxes are supposed to be paid will be paid by the fund itself. Or let's say if you come directly into India PIS account, then it will be done as a TDS, and then you will have to file your income tax returns on your own, right? Whereas if you come through dollar route, it will be done at a fund level, and you don't have to do then all of those required.
So with that, we've come to the end of the session. Time considering, a lot of questions also falling onto the podium. So I might mail all these questions to you, sir, so that each of them are answered. So thank you for giving us a wonderful PPT and letting us know the ease of investing through global alternatives.
Yeah.
Thank you.
Thank you. My pleasure, and good luck to everyone. Thank you.